Okay. So in our last class, we looked at how to value an organization. That's what we did. So as a quick way of recapping, I would want us to look at a past paper question. Yeah, there is this sitting that they gave us an evaluation of an organization, and so many students were not able to get anything at all, which was really unfortunate. This was December 2022, question number 2A. Do we have our past papers with us? Do we have our past papers with us? If you have your past papers, I would recommend that you check them, and then of course you get to mark. Whenever we do questions here, you should always mark and say, "Mwalimu, we have done this." Yeah. So December 2022, question number 2A, you'll allow me to read. It's the question of 𝗃𝗂𝗶𝗃𝗃 Limited has provided the following summary of statement of financial position for the year ending 30th September 2022. So we're given here non-current assets. You can see we have freehold land and buildings, plant and machinery, equipment. We have goodwill totaling to 560,000. Our current assets are totaling to 320,000. You can see our current liabilities, they are coming to, if you, this 160, 200,000, yes. Those are current liabilities, all right? Then when you go down further, you can see our equities and liabilities. We start with liabilities. You can see we have a long-term bond, a deferred taxation here, totaling to 160. We have ordinary shares, and then we have 6% preference shares. Required, determine the value of each ordinary share using the net asset value basis of valuation. This is something that I'd shown you how to do yesterday. Is there somebody who thinks they can make a very good shot at this, like a chief ninja? Anybody who thinks that they are very, very good at this? Because I just showed you how to do it yesterday. I just showed you how to do this yesterday. Net asset value. Yeah, so please allow me to remind you, great students of mine, whenever we talk of net asset value, we are looking at total assets minus, ladies and gentlemen, total liabilities. So basically, we are looking at a situation where the firm will be valued at the equity. The equity, what is the firm's equity? So if the firm's equity investment is 10 million, then that will be the firm value. Now remember, please remember, in case there are preference shares, you shall always deduct them. Preference shares, you shall always deduct them here. Preference share capital, deduct them. So like in this sitting, this examiner was able to knock away my students off the road towards passing because they introduced something that we are not taught. But nowadays we teach it. That, when we are selling a company, let me ask you a question. If, for example, you have your own company and you want to sell it, what is your take on this company? Will this company be doing very, very well or very poorly for you to consider selling it? For you to consider selling any asset, chances are, not unless it's an emergency, 99.9999% of people will sell assets that are struggling, assets which are struggling. And that is why, ladies and gentlemen, this examiner introduced the concept of goodwill. Goodwill. Yeah, so goodwill as part of assets, whenever you see goodwill, by the time you are selling this asset, it will not be having any goodwill. Yeah, in this case here, any, ladies and gentlemen, intangible assets will always be subtracted. So whenever they talk of patents, trademarks, goodwill, intangible assets, whenever I'm getting net asset value, intangible assets must always be deducted. So minus any intangible asset. Any intangible asset, e.g. goodwill. E.g. goodwill. E.g. goodwill. That one you subtract. Minus any intangible asset, e.g. goodwill. That one you subtract trademark, etc. By the time you're selling, ladies and gentlemen, trust you me, that asset of yours has got no goodwill. Even if it has, in terms of getting net asset value, we shall always be subtracting. So up to here, ladies and gentlemen, are we together somehow? Are we together somehow? Are we together somehow? Please talk to me. I would want to see whether we are connected. Are we together somehow? Thank you so much. So remember, preference share capital shall always be deducted because preference share capital attracts what we call a fixed rate of return. Preference share capital is like a preference share capital is like any debt instrument. They have fixed rate of return. Whether the company is making a loss or a profit, doesn't matter. Preference shareholders must always be paid a dividend. And that is why finance nowadays takes preference share capital to be part of liability, So then let's move slowly. And then we try to tackle this question, ladies and gentlemen, as a quick way of doing a recap of what we were doing in our last class. So then we're looking at the balance sheet. Basically, net asset value, we are looking at the balance sheet totally. All right. So I can see the total non-current assets here. They are 560,000. So I'm adding all the assets. So total non-current assets, 560,000. Plus, ladies and gentlemen, I can see the current ones. They're adding to 320,000. So plus 320,000 to get the total assets minus all the liabilities, of which I'll be able to start with the current liabilities, which I'm able to see are adding to 200,000. So minus 200,000 minus, ladies and gentlemen, our long-term liabilities, non-current liabilities, they are here. You can see we have a bond of 120,000, a bond of 120,000. So you subtract that. We also have deferred taxation here of 20,000. We subtract that one. It's not our money. 20,000. And then do we have any preference share capital? Oh, yes, we do. Do we have any preference share capital? Oh, yes, we do. If there is, then we shall always deduct it. You can see we have 6% preference shares, 100,000. So minus 100,000. Do we have any intangible assets amongst our non-current assets? Oh, yes, we do. We have them. We have them. We have them. So you can see we have goodwill. We have goodwill here. This goodwill is intangible. You can't touch goodwill. Goodwill is intangible. So minus 40,000. Minus 40,000. So minus 40,000. Minus 40,000. So this will be the total net asset value of the company. So net asset value of the company, is there anybody who can easily give us a figure? Net asset value of the company, anybody who can easily give us the total figure. And my wish and hope is that you're able to understand my language. We are able to communicate. That is the most important thing. That is the most important thing. We should be able to communicate. We should be able to communicate. So net assets value. So Pius gives me 112,000. Pius is giving me 112,000. Should be around 400,000. Let's be keen. Not unless there is something you have left out. It's 400,000. It's 400,000. It's 400,000. Pius, go ahead and punch again this. Punch again this. Punch, 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 punch. Punch, 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 punch. To confirm that this total net asset value is 400,000. The other students are not talking to me. Please talk to me. Please talk to me. Please talk to me. Are you able to get that 400,000 Olivia is getting? I'm waiting to hear from the other students. please. 400,000. Thank you so much. So this is the value of the farm. Farm value. Farm value. So at times they will ask you to provide what we call, ladies and gentlemen, the value per share or NAV per share. So if they tell me to provide NAV per share, this is what I shall do. If you look at this question, they want me, ladies and gentlemen, what they want me, ladies and gentlemen, to do, they want me to give them the value of each ordinary share using the NAV. So then the value per share, the value per share will be equal to NAV divided by number of ordinary shares. And getting number of ordinary shares from the balance sheet, this is normally what we do to get number of ordinary shares. We normally take the share capital, and then we divide this by the par value. We divide this by the par value. We take the share capital, divide this by the par value. So from the balance sheet, whenever you want to get number of ordinary shares, you take the share capital provided, you divide this by the par value. You divide this by what we call the par value. If you look at the balance sheet we are given, my friends, it has ordinary shares of 10 each. The 10 is the par value. And you can see here, it is coming to how much is it? 280,000? Yeah, I think so. 280,000. No, 160,000. Ordinary shares, share capital is 160. So 160,000 10. So 160,000 divide this by 10. So then this one here will end up giving me 16,000 shares. 16,000 shares. This will end up giving me 16,000 shares. And now once you get that, my good friends, you'll be able to come here and give us the NAV is 400,000. You divide this by 16,000 shares, which will end up giving me what value? Which will end up giving me what value at the end of the day? 25. So that you'll now sell your company shares at that amount. You see, we have to take this seriously because after some time, ladies and gentlemen, once you finish this course, you'll get yourself seated on a evaluations desk. Yeah, we will be told in this case here, value an organization. I mean, you should be able to remember that Dr. Aura taught you how to get value of a firm using the NAV. That should be the first low-hanging method that you should be able to use. And people will be able to know that this lady, this gentleman is really good at whatever they are doing. So now, ladies and gentlemen, is that a good recap of what we did? Because I always like connecting the earlier classes and my current classes. Great. Thank you so much. So 25 is the correct answer. Thank you so much. So then we continue here on the same sitting. This examiner wanted you to mention here, why is it important for a business to value its shares, value its assets? If you look at part B of this question, outline 3 reasons for valuing securities of a company. I would want to value securities of a company, ladies and gentlemen, for purposes of mergers and acquisitions. 2 companies would want to merge. They can't just merge haphazardly. They would want you to come in as a valuer and attach a value to the shares. I would want to value my securities, ladies and gentlemen, if I'm going to use them as collateral. If I'm going to use them as collateral in a bank, for example, I would want to do valuation if I want to sell this organization. So there are so many reasons, and I've been able to give you those reasons, ladies and gentlemen, down here in the answer. You know, I'm just moving. If you're not able to understand, I always give answers down there. Yeah, in this case, here, reasons for valuing securities of our company to evaluate whether the securities are over or undervalued. That is a comparison between market value and intrinsic value. I'll be able to come back to that later. In terms of mergers and acquisitions, there is need to determine the value of the companies involved in the exercise. In terms of liquidation of a company, it is important to value the securities in monetary terms when a company is being liquidated. When a company is not unable to pay its creditors, Yeah, and then the judge has been able to lift his hammer and said, let's sell this company. At that point, it will be important for us to value a company. Yeah, we also value shares when we want to go public, when we want to have our RCM college listed at the stock exchange. Valuation of companies, securities is important when they are to be used as what here, when they are to be used as collateral. Ladies and gentlemen, I want to believe I've given you the basics that you guys needed in this case here to be able to now value this organization. The only thing I haven't yet done, I'll be coming back to this later. We have what we call valuation of an organization using free cash flows. Yeah, where you look at the free cash flows coming and then you discount. There is a way I normally connect some of these things with other topics in the syllabus. For now, please allow me straight away to take you through now valuation of securities. Mention the valuation of securities. Valuation of securities. Valuation of securities. Remember, the topic is business valuation. Yeah, also in compliance with reporting, yes. In compliance with financial reporting. Remember, we have an IFRS, which talks about what here? Market valuation. Market valuation. Market valuation, yeah. Great. Thank you. So valuation of securities. Valuation of securities. These are those securities that you examine are called financial assets. Financial assets. Where basically your syllabus is very clear. It wants me to teach you how to value ordinary shares, how to value ordinary shares. Number two, it wants me to teach you, ladies and gentlemen, how to value bonds, how to value bonds, debt instruments, debt instruments, debt instruments. And then, of course, lastly, they want me to show you how to value preference shares. How to value preference shares. How to value preference shares. So we shall begin with the first one, which is valuation of ordinary shares. So we have here valuation of ordinary shares. So valuation of ordinary shares. Valuation of ordinary shares. Valuation of ordinary shares. Valuation of ordinary shares. I think this lighting is not the best. This is too bright. Just give me 1 minute. This is too bright. I'm almost seeing myself as a Mzungu. I hope this is a bit better. I hope this is much better, right? Is there somebody who can confirm that this light is now much better? Yeah. Yeah. I don't want a situation where I look like a Mzungu and I'm an African black man. So valuation of ordinary shares. Now, ladies and gentlemen, please listen and listen to me very well. Whenever you want to value a share or any asset for that matter, you look at the return. What is it that you shall be getting from this particular asset? When I buy a share today, what kind of benefits do I expect to get as a shareholder? As a shareholder, if I buy a share today, what benefits do I expect to get? Dividends, yeah. Dividends. So basically, whenever we talk of valuation of ordinary shares, in this case, you are supposed to know that the value of a share, will be the present value of dividends receivable. Dividends receivable. Dividends receivable. So anytime you want to get value of a share, you will take the present value of dividends done what year? Dividends receivable. Yeah, because I'll not want to pay 1,000 shillings for a share, and then I only receive like 50 shillings as dividends. No. At the bare minimum, if I'm putting in 1,000, then the total value of the dividends I'll be getting should be exactly equal to 1,000. Minimum. Minimum. Of course, there is also the concept of what here? Capital appreciation. Capital appreciation. We expect also this capital to appreciate. But for now, we're not looking at that. For now, ladies and gentlemen, anytime they talk about valuation of a share, we shall look at our benefit, which is future dividends, then we discount them. Now, let me ask you a question. Assuming in this case here we have Queen. Queen happens to get very, very good person. You know, they are very, very good people outside here. Yeah, many people are very good. So in this case here, we have Queen getting somebody who tells Queen, hey, Queen, you'll be getting 10 million Kenya shillings every year. 10 million Kenya shillings every year to infinity, indefinitely. And then R, the cost of capital, they give you cost of capital of say 0.2. Can somebody give me the present value of Queen's cash flow? So Queen gets somebody who tells her that I shall be giving you 10 million shillings per annum. Then Queen asks for how long? 2-3 years? No. Indefinitely. Infinity. This means infinity. No end in sight. No end in sight. No end in sight. Ladies and gentlemen, please remember, and remember very well, that whenever you want to get present value, when n is infinity, you will always take the amount and then you divide by r. Always you take the amount, you divide by r. You take the amount, you divide by r. Take the amount, divided by r. So Calvin must have taken this as 0.1. So then this will be 10 million divided by r, which is 0.2. So 10 divided by 0.2 now will end up giving me 50 million. Now, please, ladies and gentlemen, listen and listen to me very well. For us, when we buy a share in a company, we are not buying this share to sell it tomorrow. No, we are buying this share and stay with it long term. We call it longevity, long term. That it shall never dispose. So shall continue receiving these dividends indefinitely. And that is why our PO will be equal to DO over R, because our N is infinity. PO will be equal to DO over R. Yeah, so in this case here we have here PO. O means current market price per share. Current market price per share. DO stands for current dividends per share. Current dividends per share. Current dividends per share. Current dividends per share. Can I ask a question? Are there students who are joining us here from the evening class, who are in our evening classes? And if yes, have you done this topic? Have you done this topic? If yes, have you done this topic? It always assists me to. Not yet, okay. Okay. How about early morning students? Do we have any student who is coming from the early morning? Any student coming from the early morning? Oh, done. They've already done the topic, yeah. No worries. No worries. No worries. Oh, you started yesterday. Okay, great. Great. Then I'll be able to move a little bit slower. No worries. I'll be able to move a little bit slower, because you see, myself, I teach, yeah, those students who are repeating, yeah, this is supposed to be a special revision class. So when it's a special revision class, it means that I'm making an assumption that they have got some knowledge. So basically, I come just comb them a little bit here and there, and then I hammer past paper questions. But because I've seen guests, then today I'll be able to accommodate them. Yeah. So then we have O stands for current. So current market price per share, right in full. This current dividend per share, like that. And then this R is a required return. This R is a required return. R is a required return. R is a required return. Now, ladies and gentlemen, listen and listen to me very well. Listen and listen to me very well. Listen and listen to me very well. I've just said that this PO will be equal to DO over R over the cost of capital. But now let me ask you a question. Who goes? Yeah, only in SPR, yeah. Who goes? Yeah, we should be able to connect you also to the other classes. The SPR students who are around here, you have the right to also join our normal classes, just like the normal students. These students who are in the normal classes have a right to join SPR. They have a right to join SPR. At RCM, we want to give you variety. The more the literature you have, the better. Now, let me ask you a question, ladies and gentlemen. You see, I will not go for any organization which has got constant dividends. If a company has got constant dividends, I'll be able to show you how to join. If a company has got constant dividends, then we don't want that company. We shall always go for a company whose dividends grow. So when there is growth rate, when there is growth rate, then in this case here, my PO becomes DO, which of course has to grow. DO into 1 plus G, into 1 plus G, DO into 1 plus G. All over R, the same thing, D over R, minus G like that. But now, ladies and gentlemen, remember I'm valuing equity. Equity which belongs to, yeah, PO. It belongs to equity holders. So at the end of the day, this is how this formula will look like. PO equals DO into 1 plus G all over Kenya minus government. Kenya without government. If you remember very well, for the students who are in Kenya here, I believe even guys like Thonditi who are in Sudan, you must be knowing our former deputy president, 𝗃𝗏𝗃𝗃𝗃. We call it 𝗃𝗏𝗃𝗏𝗃𝗏's model. Remember, 𝗃𝗏𝗃𝗏 is the gentleman who was talking about shares. Yeah, that you will be able to get dividends. And remember, he was a DO, district officer, and he grew in ranks. So he was a DO who grew in ranks, became, in this case, a deputy president, and then, of course, he was fired. But since he was fired, it's like everybody got into campaign mode. It's like now we no longer have government. The opposition was able to join the government, and I mean, we can see what is happening all over. So basically, we have in this case here, a very confused state. And that is why whenever you hear about share valuation, we shall be talking of provincial officer like that, those 𝗃𝗏𝗃𝗏𝗃𝗏 guys, who is a D who was to grow all over Kenya without government. So remember, this is just for our understanding. This is just for our understanding. This is just for our understanding. I don't take sides with any party or with any, no. Myself, I'm a hardworking Kenyan. I only teach throughout, Sunday to Sunday. So I can't follow anywhere. I'm just here, just teaching like that. But I always bring in this concept of 𝗃𝗏𝗃𝗏's model for this concept here to always stick in your mind. 𝗃𝗏𝗃𝗏's model. I want to believe with that kind of an introduction to this shares concept, you guys will be able to remember. You'll be able to remember. I mean, all of us, of course, we know 𝗃𝗏𝗃𝗏, isn't it? 𝗃𝗏𝗃𝗏's model was a DO, he grew, and of course, after he was fired or impeached, I can see in this case as somebody who hates him, which of course is your right, that he is the impeached. Yeah. After his impeachment, then we have Kenya without what year? Government. Yeah. So I hope you guys Now with that concept, you'll be able to remember. But again, remember that this DO is not the district officer. We know what DO stands for. We know that DO stands for what here? DO stands for current O, current dividends per share. DO stands for current market price per share. KE is cost of equity. KE is cost of who? Is cost of equity. KE is cost of equity. And then we have G. G is the growth rate of dividends. Growth rate of dividends. Growth rate of dividends. Growth rate of what year? Dividends. Growth rate of dividends. Is that okay, ladies and gentlemen? Have you been able to pick? Have you been able to pick? Have you been able to pick, ladies and gentlemen, up to here? Have you been able to pick some great concept here? All right, then we continue. So we continue. I can see a question. Yeah, thank you so much, George, for asking. Yeah, you know, KE is cost of equity. It is a type of a return, required return. Yeah, you see, the owners of the shares, to them, they call it a return. But the company calls it cost of equity. A cost of equity. So we shall be using cost of equity for valuation of shares totally. For valuation of shares totally. For valuation of shares totally. I hope that is okay, ladies and gentlemen. I hope that is okay, ladies and gentlemen. Great. Thank you so much. You guys are hardworking, and that is why I love teaching special revision classes a lot. Pony stands for what? Are you asking about PO? PO is the current PO, current market price per share. Current market price per share. Current market price per share. I'd introduced it, eh? Yeah, current market price per share. Then I would want us, ladies and gentlemen, in this case here, to look at April 2022, question number 1, dog. 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 You are on an attachment in an investment firm, and the following information regarding investments has been provided to you by a company whose earnings per share in the current financial year was 8. The EPS was 8. The company adopts a 60% payout ratio as its dividends policy. The company is considering 2 investment options as follows. Yeah, I repeat, ladies and gentlemen, you're on attachment in an investment firm. And the following information regarding investments has been provided to you by a company whose earnings per share in the current financial year is A. And the dividend payout ratio is 60%. So, ladies and gentlemen, we can see that the EPS in the current year, the EPS in the current year is 8. So I can easily get the DPS, dividends per share, in the current year. Because out of the company's earnings, these people are paying 60%. These people are paying 60% as dividends. So we have earnings per share is 8, and then they pay out. Remember, dividend is what is being paid out. Dividend is what is being paid out. So the dividends per share current, yeah, retention will be 40, but now I'm looking at dividends per share for now. I know what you're talking about, Asa. We should be able to reach there. Yeah, yeah. All right. So, ladies and gentlemen, we have our DPS, dividends paid out. So 8 times 60, that gives me what figure? Internet issues, sorry for that. It is December. It is December no, not December, but April 2022, question number 1, dog. April 2022, question number 1, dog. Yeah, so please give me this figure. Give me this figure. So what is this DPS? At time zero means? At time 0 means today. Yeah, so 8 times 0.6. So someone is requesting for the question to be sent on the group. Please be kind enough to help Mwalimu. I know here we have got people who are very good-hearted, beautiful people. Yeah, there are some resources. Whenever students ask for them and you happen to be having them, don't wait for Mwalimu to send. You can do it on my behalf because I don't have it. And of course, you know that I'm a man, and a man, very few men are able to multitask. Very few men are able to multitask. All right. So, ladies and gentlemen, we happen to be having this DPSO, or basically what we shall be calling our DO. Our DO is 4.8. DO is 4.8. All right. Then I don't want us to look at option 1 for now. I want us to look at option 2. I'll come back to option 1 after I finish option 2. So option 2, the firm can continue with the current investment and the growth in dividends will continue at the rate of 10% per annum in perpetuity. So required, assuming the required return is 18%, advise the company on the option to take. So ladies and gentlemen, basically, they want me to use dividend valuation model. They want me to use dividend. So use dividend valuation model to determine PO between the two options. And then, of course, you'll be able to go for that particular option that question 1B. Sorry for that. For now, you can be using what I'm sharing, and then after class, I'll be able to share. Sorry for that. I'll be able to share. So, ladies and gentlemen, they want me to use a dividend valuation method to determine PO between the two. Not a problem. So how do we get this PO? I know the formula. I know PO equals DO into 1 plus G, all over cost of equity minus this G. Fortunately, we've been able to get DO. Our DO, ladies and gentlemen, is 4.8. The one we got up there. Into 1 plus growth rate. 1 plus the growth rate. The growth rate has been provided in the question. The growth rate has been, thank you so much. I can see somebody has shared a photo. Thank you so much. Thank you really so much. So you can see here in option 2, they have told us that the dividends will continue growing at 10% per annum in perpetuity. So the growth rate has been given. And you see, when growth rate is 10%, this is the same as 0.1. So 1 plus 0.1, all over cost of equity. Cost of equity, which is the same as required return. They've told me it is 18%. 18% is 0.18 minus the same growth rate of 0.1. So then are you able to give me the final answer? Is there somebody who is able to give me the final answer? So according to Queen P, she's getting 66. You must be very careful here. You say 4.8 times 1.1, you write an answer. You write an answer, whatever you get, you write here. Yeah, and then you come and say divide by this minus this, gives me 0.08. Gives me 0.08. Yeah, you must move slowly there so that you don't lose any mark. You don't lose any mark. Achola has also confirmed that option number 2 is giving them 66. So this is option number 2. I simply wanted to use option number 2 to show you how we are valuing a share using this perpetuity method. The Gachagwa's model, perpetuity method. Perpetuity, thank you so much, Caro. Perpetuity method. And with your permission, then I'll be able to go back and look at what they have for us in option number 1. Can I go to option number 1? Can I go to option number 1? Can I go to option number 1? Thank you so much. Now, as I go to option number 1, ladies and gentlemen, it will be important for you to also take note of the following. That this DO into 1 plus G is the same as D1. Is the same as D1. And the D1 is what we call expected dividend. Expected dividend at the end of year one. At end of year one. Expected dividend at end of year one. Expected dividend at end of year one. Expected dividend at end of year one. At end of year one. So DO is today's dividend. Then we have D1. And that is why you realize some books telling you that PO, you realize some books telling you that PO, I'm just preparing you. I'm just preparing you because I know how these examiners will want to twist you. You'll get some books saying that PO equals D1 all over KE minus G. Yeah, because already they have taken the initial dividend and grew it to make D1. So end of year dividend divided by Kenya minus government, like that. So I'm just preparing you. And if you don't mind, you can write this and then you put it in brackets, not brackets, but in a box, or you can even highlight this. I'll come back to this. This is really important. This is really important. We go to option number one. Option number one was really interesting. So for option number one, they told us here, the farm has an investment opportunity. Yeah, the farm has an investment opportunity, which if undertaken, the growth rate in dividends will be 10% per annum for the next 3 years. The growth rate will fall to 8% per annum for the next 2 years. After the first 3 years, and then stabilize at 6% per annum thereafter. There's a problem here. The farm has an investment opportunity which, if undertaken, the growth rate in dividends will be 10% per annum for the next 3 years. The growth rate will fall to 8% per annum for the next 2 years. Next 2 years. I think this after first 3 years is misplaced here. Yeah. Yeah. For the next 2 years, after the first 3 years, yeah, it's correct. And then stabilize at 6%. There is no problem. So, ladies and gentlemen, this one, I will be able to get it very well. Very well. Now, please listen and listen to me very well. Listen and listen to me very well. Remember, we have current dividends. We have current dividends. We have current dividends. So the current dividends, what we are calling our DO is 4.8. So remember, this is option one. Option one. So option one, what I will do, I will come and write time. Time. Yeah. I can write time there. Yeah. So I will always start with 1. Yeah. Because I'm valuing a share using future dividends. Future dividends. So this will be 1, 2, 3. And then we have year 4, year 5. Those 2 years. And then now we have, in this case here, infinity. 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 Yeah. Remember, these current dividends, these are our DOs. Don't forget that. Yeah, this is current, it's historical, it has already been paid. We cannot use this figure to value a dividend, to value a share. We can't use it. We're looking at from end of year 1, end of year 2, and so forth. So, and don't forget, of course, to get like D1, I will take DO into 1 plus G. Don't forget that. Don't forget that. So in this case here, let's get expected dividends. Expected dividends. Expected dividends. So they have told us, of course, here we'll talk of 4.8. They have told us for the first 3 years. For the first 3 years. For the first 3 years, the growth rate will be 10% per annum for the first 3 years. First 3 years, like that. Next 3 years, doesn't matter. So 10%. So now talk of 4.8 times 1 plus 0.1. Is there somebody who is able to give me this figure? 4.8 times 1.1 So Joanne is giving me a figure of 5.28. Thank you so much. So we have 5.28. We shall still pick this and multiply it with this one plus 0.1. Because the 0.1 is constant for the next 3 years. 0.1 is constant for the next 3 years. Yeah. So let's put 3 decimal places. Let's put 3 decimal places. I know why. Let's put 3 decimal places. 3 decimal places. So then we have here 5.808 in this is the last year. 0.1 like that. That is the last year. That is the last year. So Pius is giving me 6.388. What happens, ladies and gentlemen, after the first 3 years, 10% is exhausted? What will happen? What will happen? What have they told us after the first 3 years? After the first, or 389, eh? I'm told it's 389. 389. 389. Let's first of all be in agreement, all of us. Are we supposed to stick with 6.389 or 6.389 wins? After that, for the next 2 years. After that, for the next 2 years, they have told us abracadabra. After that, for the next 2 years, they're telling us here, the growth rate will fall to 8% per annum for the next 2 years. So 8% per annum. Now, please listen. I'm aware. I'm a scholar. I know you can come and say, like now this one, you can say 4.8 times 1.1 squared. I know. You get the same answer, but I prefer going it longer this way, because this way you will never 3 decimal places. Yeah, 6.3. Yeah, great. Thank you so much. So then we come here to year number 4. We are continuing with this dividend here. So it will be 6.389 into 1 plus 0.08, because now the new rate is 8%. So can you then be kind enough by giving me this answer? Please be kind enough by giving me this answer. 6.900. Thank you so much. So this 6.900 is what I bring here. Still, the 8% is applicable. The 8% is applicable. Still, the 8% is applicable. Because 8% is for these 2 years. 8% is for those 2 years. 8% is for those 2 years. So Joanne gives me 74.52. 74.52. 74.52. Ladies and gentlemen, from there now we go to what we are calling infinity, because they have told us thereafter, we are going to have a perpetual growth rate. Thereafter, we are going to have a perpetual growth rate. Yeah, and then stabilize at 6% per annum. Thereafter, up to when? They're not telling for how many years. They're not telling us for how many years. So thereafter, it means that we shall enjoy these 6% indefinitely. Ladies and gentlemen, whenever you see infinity in finance, just remember that in our politics, the only person who is infinite, who will be seen all over, is 𝗃𝗏𝗃𝗏. So whenever you see infinity, always remember 𝗃𝗏𝗃𝗏's model. And the 𝗃𝗏𝗃𝗏's model, our PO will always be equal to DO into 1 plus G all over KE minus what? KE minus G. So I want to value the infinity cash flow. So the next step, let's value infinite. Value the infinite cash flow. How do we value it? It is the one we are using 𝗃𝗏𝗃𝗏's model, because 𝗃𝗏𝗃𝗏 will still be, you may even be surprised, even Ruto, having him and Ruto having a handshake. These are guys who cannot miss, like from the political cycle for so long. So if you ever get to hear about indefinite, just remember 𝗃𝗏𝗃𝗏's model. Now, ladies and gentlemen, please listen. Our DO will be our most current dividend. This dividend here, the most current dividend. So this will be 7.452 into 1 plus the perpetual growth rate. The perpetual growth rate is 0.06. All over the cost of equity. Cost of equity or required return has been given by the examiner. The required return has been given by the examiner. Required return is the same as cost of capital. You can see here. Assuming the required return is 18%, this is the cost of capital, the R or the KE. The required return is 18%. So in this case here, we have 0.18 minus our growth rate, which is perpetual, which is 0.06. 0.06. So I would want you guys to do me a favor. Please move slowly. Move slowly and give me, of course, you're writing down here. Please give me the numerator. Is there somebody who is able to give me the numerator here? There is somebody who has already gotten the final answer. Somebody has already gotten the final answer. 65, 826. Somebody has already gotten the final answer. 826. But how I wish you guys could just give me the numerator here. How I wish you guys gave me the numerator. I know the denominator. I know the denominator. It will be 0.12. How about the numerator? 7.899, something like that. 7.899, like that. So when you divide, then you'll be able to get something that is quite close to this. Yeah. Ladies and gentlemen, yeah. If there is anything that I would want you to really gain out of this session is how to calculate this infinite cash flow. Yeah, pardon, 18% has been given. 18% is the required return. It is here. 18% is a required return. It is here. Assuming the required return is 18%. It has been given, right? How have you been able to see it? So anytime you hear about infinite, yeah, always remember that 𝗃𝗶𝗹𝗆𝗃 shares man, DO, growing, Kenya minus government. Yeah. So the moment you have this, then what do? Now you shall be able to discount these future cash flows. You discount them. You discount them. So and you can see that there are irregular cash flows. So you need to come here and compute what we call the discounting factors. So compute the discounting factors. Which is PV, present value interest factor, like that. Is there somebody who could be remembering? Is there anybody who is able to remember? Yeah, this is the same as terminal value. Same as terminal value. Same as terminal value. I'm so sure you guys have got other ways of computing this. I know all those other methods, but I'm 100% sure that this is really what will click in your mind for the longest time ever. So discounting factors, is there somebody who is able to remember the PV formula? PV formula. Anybody who is able to remember the present value interest over interest factor? I almost said annuity. Present value interest factor. Yeah, I know the formula. It is 1 plus R raised to negative N. So it will be 1.18 raised to negative 1. We have 1.18 raised to negative 2, 1.18 raised to 1.18 raised to negative 4, 1.18 raised to negative 5. 4 decimal places. Remember, PVs will always be in terms of 4 decimal places, always. Where am I getting 1.18 from? Remember, it is 1 plus R, and our R is 0.18. That's how I got my 1.18. How I wish I would get somebody who can give me these answers pretty fast. How I wish. The first one, I'm being told it's 0.8, 84, 84. The first one, 0.8475, the first one, 0.8475, the first one. The second one is 0.7182, 0.7182. 0.6086. 0.6086. Thank you so much. 0.5158. 0.5158. And then we have the last one. Now we have the last one, which is year 5. Year 5, the very last one, 0.4371. 0.4371. 0.4371. 0.4371. Now, please listen. And this is where so many guys go wrong. This is where so many students go wrong. Remember, there is nothing like growing after this. End of year 5 is the end factor for everything. So given that this is a terminal cash flow, whatever you have here, you see now you can't come and let's say 1.18 raised to negative infinity. No. So we normally repeat this number. We repeat that number there. Whatever number you have up there is what you repeat down there. Because already things terminated at the end of year 5. Yeah, we have been able to pull this infinite to the end of year 5. So then once you've done that, come and give me the discounted cash flows. Give me the discounted cash flows. Please never forget that for the terminal value, the infinite value, we always borrow whatever that is here. All right, so now we are multiplying. So the first one will be this multiplied by this discount factor, which in this case here, somebody is giving me 44,745 with a decimal there. Thank you so much. The second one will be 5808 times 0.7182. 41,713. 41,713. Decimal there. Thank you so much. Decimal there. Okay. Okay. So the second last, ladies and gentlemen, what do we have there? 38,883. 38,883. Thank you so much. Thank you so much. $38.76, I'm told. $38.76, I'm told. Thank you so much. Then 74.52 times 0.4371. I'm alone, but I'm overcoming. I'm alone, but I'm overcoming. 32.57. 32.57. Then move on to the next one. The next one, what do we have here? 65.826 times 0.4371. $28.772, 28.77 something. 28.77. 28.7725. Decimal. This was a decimal there. Then come and give me the present value, which will be the same as my PO. Which will be the same as my PO. You add everything now. You add everything now. 28, thank you so much. Now you add everything. So according to Pius, we have 48.4396. 48.4396. So are we together there, ladies and gentlemen? Are we together there, ladies and gentlemen? Year 4 being corrected is supposed to be 3.5590. Year 4 I'm being corrected here is supposed to be 3 point, this year 4, 48.125. Year 4 I'm being told this is wrong. Yeah, 4, I'm being told this is wrong. Yeah, 4, I'm being told this is wrong. It's supposed to be 3 point. Thank you so much, Elizabeth, as well. Let's have everything correct. Thank you, Calvin. 3.5590. Yeah, then can you kindly come and give me this sort of figure here? PO will be equal to who? PO will be equal to who at the end of the day? PO will be equal to who at the end of the day? 42.1229. Oi, can it be 42 from 48? I doubt. 48.125, eh? It can't be 42. Just add properly. 48.125, like that. So now please compare the two. If I go this way, my share is worth 48.125. If I go, this is option 1. If I go through option 2, my share is worth how much? Was this 66? 66. So then in this case here, myself as an investor would want always a higher share price. As an investor, I would want a higher share price, and therefore, I recommend option number what here? I recommend option number 2. I recommend option number 2. I recommend option number 2. It's better. Option number 2 is better. I recommend option number 2. Option number 2 is better. Is that okay, ladies and gentlemen? So this one, I will repeat the whole of it using another question. I just wanted to bring it to your attention. But are we together up to there, my good students? Please give me feedback. Please give me feedback. Are we together? Now, please give me a title there. Methods of computing growth rate. Because in most cases, your examiner will not give you growth rate. Your examiner is not your sister. Your examiner is not your brother. He's not your father. He's not your mother. Your examiner would want you to suffer. So he cannot give you growth rate nowadays directly, but a good student will be able to remember this. So give me a title there, methods of computing the growth rate. 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 G. Methods of computing the growth rate. So number 1, we have in this case here what we call retention ratio method. Retention ratio method. Retention ratio method. That's number 1. Retention ratio method. So retention ratio method, we basically say G equals RBE. RBE. G equals RBE, where R is the retention ratio, R is the retention ratio, yeah, and then we have in this case here our BE being the return on equity. Return on equity. Return on equity. Very important, ladies and gentlemen, for you to appreciate this method called the retention what here? Ratio method. It's called retention ratio method. And ladies and gentlemen, even in our normal lives, if you want to grow, assuming you are getting a salary of 100,000, if you're getting a salary of 100,000 and you're blowing up everything at the end of every month, you're not retaining anything, you will never grow. So you must, ladies and gentlemen, in this case here, be able to retain something. We must retain something. Maybe you are retaining 50%. If you retain 50% and then you leave this money in just a bank account there, not earning interest, then at the end of the day, you will not be growing. If you want to grow, so growth rate is a function of 2 things. Retain something with yourself and invest these in equities which are having a return. So growth will be a function of 2 metrics. You retain and then you invest in equities giving you a return. So this is very, very important. And normally this is what they normally do. They'll tell you that the payout ratio as an exercise, payout ratio is 0.75. Yeah. And then they'll tell you return on equity is 10%. Required, give us G, the growth rate. Let me give you 1 minute. You try this out. Give us G, the growth rate. Give us G, the growth rate. Yeah, so please remember that payout ratio and retention ratio must add up to 1. Retention plus payout ratios, they must always add up to 1. Now that they have given you the payout ratio, then retention ratio will be 1 minus payout. So it will be 1 minus 0.75, which gives you 0.25 like that. 0.25. And then now you can come and use this formula here. Which says that our growth rate equals the retention. Retention is 0.25 multiplied by our return on equity. Which is 10%. So can somebody in this case here confirm to me that this one here will end up giving us 2.5%? 2.5%. You can say 0.25 times 0.1, whatever answer you get times 100, it'll end up giving us 2.5%. It'll end up giving us 2.5%. So is that okay, ladies and gentlemen? Is that okay, ladies and gentlemen, for all of us? Yeah. And then now number 2, we have what we call compounding method. We have what we call compounding method. So under compounding method, what are we supposed to just remember? Under compounding method, we shall compare two dividends. So we have here dn over do. And then you give us what we call the nth root. And then whatever you shall get, you shall come and take away 1. Compounding growth rate from that compounding formula. Yeah, from the compounding formula. And then I will be able to, ladies and gentlemen, give you a question, an illustration. A company has been paying the following dividends. A company has been paying the following dividends. So we have here 1, 2, 3, 4, 5. So we have here dividends per share. So dividends per share, what do we have? We have 5.23. We have 5.5. We have 5.85. We have 6.25. You can see the dividends are growing. Then we have 6.6. 6.6 like that. So we are required to determine growth rate. We are required to determine the growth rate. Yeah, lost on retention ratio. Someone to share the screen. Retention ratio, what happened here? You see, that's very easy, really. If you're told the payout ratio is 0.75, Hassan, how much is retaining? How much is being retained? Hassan, you can even see this one. Retention ratio will be the opposite of this. Yeah, 0.25. If they are paying 75%, then we retain 25%, right? Yeah. And then now to be able to get our G, you take in this case here, this retention times in this case here, equity return. So they arrived very fast. So then we come back to this, ladies and gentlemen. We come back to this, ladies and gentlemen. Yeah. So then what do we have here, my good students? So my good students, what we have here is that our G will be equal to the nth root of dn over do, yeah, minus 1. Yeah. So remember, dn is the most recent or current dividend per share. Do is the oldest, in this case, oldest DPS. So basically, this is your DO, D1, D2, D3, D4 like that. D4 like that. D4. D4. Then, ladies and gentlemen, what we shall be doing is this. So then G, yeah, will be equal to Dn, yeah, most recent, is this D4, 6.6 over DO, 5.23. Yeah. How many years are in between? How many years are in between here and here? How many years are in between? Are they 5 years or 4 years? 4 years, because you are counting like this from here. 1, 2, 3, 4. Myself, I like taking this 4, fourth root. So fourth root. So it is fourth root of 6.6 divided by 5.23 minus 1. So is there somebody who is able to give me this growth rate? Is there anybody who is able to give me this growth rate? Anybody who is able to give me this growth rate? Yeah, you can also decide to use n minus 1. So say 5 minus 1. But the better approach, regardless of the method you use, then remember, this will be 4, not 5. Will be 4, not 5. So don't forget, put this in brackets. So first of all, you say 6.6 divided by 5.23. And then on your calculator, look for something called xth root. Xth root. Not xth root. Xth root. Once you see that xth root, you will come and say 4, and then you say shift for this xth root to be shown on the screen. Once it's shown on the screen, now you can come and put this into brackets. 6.6 divided by 5.23. And then you say, close bracket, you say equals. Whatever answer you get, you subtract 1 from it. Whatever answer you get, you subtract 1 from it. You'll get 0.00 times 100. That's what these ninjas are getting as 5.9, 5.9 something, right? 5.9 something. 5.99%. 5.99%. And of course, there are those students who can never see this xth root. I know them. There are those students who can never see this xth root. I know them. I know them. If you can't see the xth root, you know, this is the same as saying 6.6 divided by 5.23 raised to a quarter. Fourth root is the same as raised to a quarter minus 1. So for some people, raising is easier. So then what you need to do is to come and say here into bracket 6.6 over 5.23. Yeah, you say raised to 1 over 4, you close. You must put this 1 over 4 in brackets. So you say raised. I know you can see the raised in your calculator there. Raised. I know you can see it. And then you say minus 1. So what answer are we going to get at the end of the day? Shall we get at the end of the day the same answer? Shall we get the same answer? Shall we get the same answer? It will be the same, yes. So then if you want to use this approach, whenever you see 6th root, then here it will be raised to 1 over 6. Very, very important. This is really important, and this is where I would want us to pick from our next class. It has been a pleasure hosting you. We are overcoming every day, every day. I want to work on this handout a little bit. I can't promise to give it today. Yeah, I want to finish this chapter very well, and then I just share it. in the group. Otherwise, thank you very much. Be blessed, and please revise. Please revise. Bye. And of course, market these special revision classes in your classes. Tell the other classmates that this class is very important for them, because here we are doing practice. Bye. And of course, if there are students who are very new, who want to join RCM, I mean, the best college in East Africa, they should not hesitate giving us a shout. That's our number, 0793 555 000. Thank you. Yeah, I'll be able to organize that immediately after this. Yeah, immediately after this.